Good morning and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald. I've just had a great run. I'm in a great mood and I can't wait to talk about the markets. Thanks for spending a few minutes of your time with me today. The markets, speaking of which, are split as I type. The NASDAQ, of course, has just touched a new record high yesterday, but this morning the story is right back to trade. Steady as she goes. Don't get distracted, at least for now anyway. And once again, I anticipate that this season's earnings are going to be stronger than many people expect, which is A, going to introduce some volatility because so many big money traders are still offsides, and B, it'll prove to be yet another tremendous opportunity for individual investors. So pay attention, particularly when it comes to tech. Now, speaking of tech, not all tech is the same. So it's important that you choose wisely. But that too is a story for another time. I'm sure we're going to be talking about it plenty in the weeks ahead. Meanwhile, I want you to keep this in mind. History shows very clearly that being invested in markets that may not be perfect beats waiting to invest in perfect markets. Here's my playbook. Number one, of course we got to start with this. Nvidia, number one, Naysayers, 0. Really, it's a scorecard. Again. Yesterday, Nvidia briefly touched $4 trillion market cap, making it the first company in history to cross that milestone. Think about that for a second. A decade ago, Nvidia was a niche GPU maker riding the gaming cycles and had a market cap of just $11 billion and a split-adjusted share price of around $20 a share. Today, Nvidia is the backbone of modern markets, not to mention one of the greatest investing opportunities in recorded human history, certainly in modern markets. Now, people have argued with me the entire time, for years actually, about how expensive Nvidia is or how overvalued it's become, both of which are just new iterations of the same tired old argument. One particularly nasty individual who I recall just couldn't let go. And he called me every name in the books out on the internet, well, insisting that Intel was the better value. Perhaps not surprisingly, he's vanished into the ether, and like many others, I haven't heard a peep from him for the past 24 months. Then, of course, there was a particularly precocious young analyst who billed himself as a valuation guy, and I think still does. He produced loads of spreadsheets to prove his point, usually while being very rude and in my face about it. And suddenly, imagine this. He's concluded valuations don't matter, and he's embraced my talking points as if they're his own. PE, PS, so price to earnings, price to sales, and other metrics no longer matter, he's busy telling folks, when it comes to companies like Nvidia and Palantir, for example. Yes. Anyway, Nvidia has returned 33,894.98% over the past 10 years, while Intel, the company to which I was often lambasted and compared against, has returned 4.13% over the same time frame. Now, if both of what these individuals had insisted to be true back then was actually true, the numbers would have been reversed, but they're not. Anyway, to each his own. Still, the valuation crowd, and I don't want to make fun of them because this is serious, right? But the valuation crowd has a hard time letting go, and I get it because the concept of valuations has been sacred ground for 100 plus years of investing history. And if you're talking tractor parts and other hard goods, you know what? It still is. But digital spend? Not for at least a decade. That's even more reason to focus on what happens next, particularly with a company like Nvidia as far as I'm concerned. Now, I'm wondering if it wins the race to $5 trillion. I think it's going to get there. My POV, markets are constantly evolving, which means that your thinking, your approach, and your tactics must too, at least if you're a serious investor. And of course, I'll be here if you'd like some help. Obeyers, by the way, if you're wondering about what I called value investing's blind spot, be sure to check out the December 2024 issue where I wrote about it in considerable detail. It's in your archives, available via your portal. Number 2 today, pay attention when DC and Wall Street both throw money at the same company. Now, this is interesting to me. It's one of these things that came out of left field, but was actually kind of telegraphed in April when you think about it. The Defense Department has announced that it will be buying $400 million worth of preferred stock in MP Materials, which, ta-da, owns the only operational rare earth mine in the United States. Now, I'm not crazy about the government getting into business, but I'm not entirely surprised either. It's very common overseas with other countries. Rare earths are a critical part of the military weapons systems and other manufacturing, including electric vehicles, wind turbines, smartphones, and MRI machines, just to name a few of the use cases. So why now? Well, here's the thing. the U.S. is almost entirely dependent on rare earth imports, some 70% of which come from China according to various sources. Now, the Pentagon is stepping in with a 10-year guarantee that every single magnet, think about this, 10-year guarantee, every single magnet made at MP Materials' new 10X facility will be bought either by defense or commercial customers. Now, Uncle Sam is also putting a floor under MP's profits, guaranteeing $110 per kilogram for NdPr, the rare earth compound used in permanent magnets. Now, in other words, if market prices dip, the U.S. cuts a check. Now, meanwhile, you can't do this stuff in isolation, right? So J.P. Morgan, one of my favorite banks, and Goldman Sachs are apparently back in the deal with $1 billion in financing. Plus, MP expects a $150 million loan from the Pentagon to beef up its rare earth separation operations at Mountain Pass. Now, should you buy MP, right? Several ideas come to mind. Loads of people are going to jump in because of the headlines, but you don't want to be the last person at the party before they turn out the lights any more than I do if you can help it. I think the better move is to wait for a pullback after the go-fast crowd settles down, and they will. Don't know when, but they will. And at the same time, I want you to keep your eyes peeled for any other microcaps that happen to stumble into the rare earth strategic metal space. And finally, putskis could be, meaning a bet that stock will go down, could be interesting now that all the focus is on the upside. Not to mention cheap, too. Structured demand equals a runway. It's worth thinking about. All right, number 3. Talk about vindication. All right, this one just, boy, I feel good about this. Uncle Elon, as in Elon Musk, just confirmed that Grok will be integrated into Tesla vehicles next week. Not next year, not next month, not 6 years from now, next week. This isn't just a new feature. It's a game changer of the first order and something I've been talking about for several years. Musk is thinking so far beyond cars that it's not even funny. With Grok on board, drivers are going to have real-time conversational AI woven into their daily lives, not just their drive. It's a rolling AI platform, a robot, not even a car or even a truck. Meanwhile, Alexa, aka she who shall remain nameless in our household, is still dumber than a bag of rocks unless you like being told this is what I found on the web 37.28 times a day. Siri is better, but marginally so, as Apple's addressing that problem differently via their own form of LLMs and vertical platforming. Ford, on the other hand, oh man, don't even get me started. They're busy touting touchscreens and hands-free highway driving, connected services, and complementary mobile service. Full self-service driving versus hands-free highway driving, no city, no nothing, and repair guys still got to come to you. My car updates itself. I mean, it's interesting. Anyway, you know what to do. Keith's investing tip. The best opportunities almost always look ridiculous before they look genius, as do the individuals leading the charge. Controversial or not, you want to think about being on board early, pun absolutely intended, or get comfortable with the fact that you're not. Either way is good. Number 4, Delta pops, but you know what? I'm not boarding it. I'm not getting on. Delta shares have jumped roughly 10% as I record this after management has slapped a fresh coat of optimism on its 2025 forecast. CEO Ed Bastian says bookings have stabilized. All right, that's a $5 word, which is a lot like saying the plane's not crashing, it's just gliding lower. Adjusted EPS is now pegged at $5.25 to $6.25, down from the $7.35 plus they were hoping for earlier, the last time they talked about this stuff. Meanwhile, they're trimming flights during off-peak times and leaning hard on premium seats and Amex points to pad revenue. All right, color me unimpressed. Yes, Q3 guidance beat the street, 125, 175 versus 131 expected, right? But revenue per seat per mile fell 4% and fares are sliding. So airlines for me are still a no-fly zone for a lot of reasons, not the least of which is high debt, prone to economic shock, fuel roulette, and legacy labor contracts. Now, Keith's investing tip here, this is something you want to think about, right? The markets are splitting. They're not all equal. You can't think about all companies the same way. Companies with serious pricing power are almost always better bets, better investments than those where a passenger snack choice can blow the margin. Just saying. The trade idea here is if you're tempted by the bounce, I get it, but consider a short-dated put spread or skip the sector entirely. There are better landings elsewhere, pun absolutely intended. There are better places to put your money to work, in my humble opinion. I mean, Maybe I'm right, maybe I'm wrong, maybe I'm crazy. I don't know. But one of my favorite recent choices is well into the double digits, as I mentioned it less than a week ago, for example. Now, to be fair, the company I'm talking about is a speculative choice rather than a mainstream core holding, but that's the trade-off I'm encouraging you to think about. Smart investors constantly weigh choices, like Delta, against other opportunities, and if needed, adjust. And I encourage you to do exactly the same thing. Number 5. This is a $3.1 billion breakfast hangover in the making, as far as I'm concerned. Ferrero, which is the maker of Nutella and Ferrero Rocher candies, which I love so much every holiday season, is buying WK Kellogg for $3.1 billion, sending Kellogg shares up 30%. Now, Kellogg is home to, super unhealthy childhood cereal staples like Fruit Loops and Frosted Flakes, and it was spun off in 2023. Now, I ate a ton of both of those cereals growing up, so maybe that explains a lot about me today, but I digress. The point I want you to think about is that the company had a market cap of roughly $1.5 billion before the deal, meaning Ferrero is paying a hefty premium. The acquisition deepens Ferrero's U.S. ambitions as it pushes beyond candy into broader packaged foods. But here's the thing, right? The company recently launched a peanut Nutella and Dr. Pepper Tic Tacs. I mean, Dr. Pepper Tic Tacs is part of its American expression. I get it. I mean, I love an occasional Dr. Pepper. But I'm scratching my head here. We know that junk food is a problem because of all the stuff that's worked its way into our food supply over the years in the name of food science and profits. Cereal, in particular, continues to struggle as consumers shift towards healthier breakfasts and cheaper private label alternatives. I mean, it'd be one thing if this deal looked strategic or like a bailout, but that doesn't appear to be the case here. Ferrero is simply betting on a revival. Now, to be fair, right, I could be missing something. But this reminds me of those classic Japanese deals back in the day, late 80s, early 90s, when the concept of return on capital was apparently not at the deal-making table. I cannot possibly imagine how this ends well for Ferrero. If I owned Kellogg, and I don't, I'd think very seriously about getting while the getting's good. Today's bottom line, many people think you've got to take huge risks to make big bucks, but I don't think that's quite right. What you've got to do is take smart risks. Now, let me explain the difference. Most people ask themselves, what am I going to lose if I do X, Y, Z? But the most successful investors and traders flip that around. They say, what will I lose if I don't do X, Y, and Z? My point is that you've got to be in to win or you won't win. As always, let's make it a great day. Thanks for spending a few minutes with me today. You got this, I promise, and I will see you tomorrow.